Hi, welcome back to Joe Blogs. In today's episode, I want to talk about the potential recession that's coming in 2023, and specifically to look at the job cuts that have been announced by a number of high-profile technology businesses over the last few months. So we've seen announcements most recently from Amazon that they are laying off 18,000 people. And this is actually an upgrade from the previous announcement that was made back in November that they were intending to lay off 10,000 people. So it's almost double the amount. And we've also seen similar announcements coming out from companies like Meta and Twitter and Salesforce. So there's a lot of things going on right now in the technology sector. And in today's episode, I want to look at why the technology sector is important, why it's a bellwether for the whole economy. Because if it's happening in the technology sector right now, it's likely to feed through into mainstream industries over the course of the next 3 to 6 months. We'll then go through the impact of redundancies on a business, what the costs of it are, and why it has a detrimental impact on the growth of the company. We'll look at what's been going on with regards to share prices, because a lot of these technology stocks had inflated share prices over the course of the last couple of years as all of the growth and excitement came into that sector. And we're now seeing that bubble bursting and prices have come right off. We'll have a look at some of the statements that have been made by companies over the course of the last month or so relating to these large redundancies. And then finally today I'll wrap up with my summary as to what I think is likely to happen in the job market over the course of the next 3 to 6 months and what the impact of that is likely to be on the global economy. So before we get started on all of that, if I could ask you for a thumbs up at some point during this video if you're enjoying the content, please subscribe if you haven't done so already. Don't forget, I always include chapters, so if you don't have time to watch everything, you can pick and choose what you'd like to see. And if you'd like to support the channel, please have a look below where you'll find links to YouTube Super Thanks and membership, as well as Buy Me a Coffee, Patreon, and Amazon shopping links. And as always, I'd like to say thank you so much to everybody that has supported the channel. I really appreciate it. Now, as I mentioned at the start of the video, technology companies act as a bellwether for the economy. They give us the heads up as to what's happening, what the way forward looks like. And the reason for this is that technology companies are valued against future expectations and future earnings. So this is why companies like Facebook and Google and Tesla were able to float onto the stock markets and achieve huge valuations at a time when they were making huge losses, because all of the investors were looking at the future potential for those companies. They knew that at some point those businesses would hit a breaking point where they would suddenly trigger into profitability, and that profitability would become significant. So technology businesses are looked at, analysed and valued on completely different metrics to bog standard trading businesses. In a traditional business, you'll look at the revenues and the profitability of a company, and then in order to achieve a valuation, the market capitalization of that business, a multiple is applied against that profitability. Those metrics don't apply to technology. And one of the reasons that investors love technology is that it future-proofs that business. If you're at the forefront of what's happening in terms of latest developments and research, then you know that you'll stay at the cutting edge. You won't get left behind by new developments. This table shows the most valuable listed companies in the world by market capitalization. And you can see that right at the top of this list is Apple, which is obviously a technology company. The second largest company is actually a Saudi Arabian petrochemical business. The third largest company is Microsoft. Number 4 is Alphabet, which owns Google and YouTube. 5 is Amazon, which is predominantly an online retail business. 6 is Warren Buffett's investment company Berkshire Hathaway. 7 and 8 are United Health and Johnson & Johnson, which are both in the pharmaceutical sector. 9 is Visa, the payments business. And 10 is ExxonMobil, the oil and gas business. So you can see the importance of technology from this list. And actually, if we'd have been looking at this chart 12 months ago, it would have looked entirely different. Because as you can see from the graphs on the right-hand side here, there has been a significant fall in value for a lot of these businesses. This time last year, the market cap of Apple was more than $3 trillion compared with $2 trillion today. And you can see that there's also been a significant fall in the valuation of Microsoft, Alphabet, and Amazon. So why are technology businesses valued differently to traditional companies? Well, one of the reasons is because of the cost of research and development. So if you're a technology business, you may have to spend hundreds of millions or even billions on developing your software, your business, your technology before it can launch to market. But if you've got something that's going to be a groundbreaking idea, something that could be absolutely enormous, then investors are prepared to take a view on that. They will look forward as to what the market might look like in 3 or 5 years' time and take a view that you could be one of the companies that has the cutting edge, that is the first mover in that market, and therefore can capitalize on all future demand. So a great example of this is Tesla. Tesla was one of the first companies to come up with the concept of an electric vehicle and went into mass production. But in order to get to that situation, Tesla had to invest hundreds of millions of dollars. And that meant that each year it was making huge losses. And at face value, therefore, you would say that the company had no value. But investors knew that there was going to be increasing demand for electric vehicles at some point in the future, and Tesla looked like it was going to be a really good bet. It was going to come to market first. It had a design that was futuristic, that looked much more exciting than a lot of the other electric vehicles that were being proposed by traditional manufacturers, and therefore investors took a view that a Tesla was going to be a winner. And when it launched onto the stock market, it became one of the most valuable companies in the world, despite the fact that at that point it had only delivered a relatively small number of cars compared to the traditional car businesses. And even today, the number of Teslas on the road are a fraction of the number of cars that companies such as Ford and General Motors have. But the valuation of Tesla is significantly higher. It's still ranked in the top 15 companies in the world. And if we were going back in time to 2022, before the Tesla share price crash, Tesla was actually one of the 3 most valuable companies in the world, despite the fact that it's still not making profits that justify that sort of valuation. And this is because everybody's looking at what's happening in the future. But the problem with taking a forward-looking view on valuation is that if things change, if things start to move against that company or against that sector, then that valuation can come crashing down very quickly. Now, another reason that technology businesses are often valued on future earnings and future expectations are because of scalability. So scalability is a term that refers to a business that once it has everything in place can have an exponential increase in earnings without having to have an exponential increase in costs. So a great example of this is Google. So when Google was first established, there were a lot of costs in terms of developing the software, putting in place all of the infrastructure that was needed. But as soon as everything was in place, Google started earning money from advertising revenue from companies and people that wanted to promote their services on the Google platform. As Google grew globally and became the #1 search engine all across the world, the number of hits increased, and therefore the amount of advertising revenue that Google was earning increased on a daily basis. And investors in Google sat back and watched the revenue and the profits explode. And that's why Alphabet is now one of the largest companies in the world. But the problem with advertising revenue is that it's one of the first costs that companies cut back on when times get hard. If you're having to trim your budgets, you're needing to reduce your costs, the first thing that a lot of companies look to is their advertising and marketing spend. They will assess whether or not they're achieving the return on investment that they should be for that sort of spend. And if they're not, then they will cut that. And that's what we're seeing right now. And that's one of the reasons that technology businesses are now seeing a reduction in revenues and why they're having to cut back on their workforce, because traditional companies are cutting back on their marketing and promotional expenditure, and therefore digital businesses such as Alphabet and Meta, which includes Facebook and Instagram, are seeing a reduction in their advertising revenues and are having to trim their own cost base. And one of the other reasons that technology businesses have such high valuations is that they're constantly coming up with new ways of doing things, either creating new products such as Apple when they bring out new phones and iPads, or developing the next generation of software and better ways of doing things. But the problem with that sort of business model is that when we do go into a wider recession, such as we're experiencing right now, standard and traditional businesses may decide that they don't need to upgrade all of their equipment overnight. They don't need to to have the latest software release because what they've got is good enough. If you're looking to cut your costs, then you might not want to spend another 10% upgrading all of your equipment this year. You may decide that you can wait until next year. So we see a general reduction in spend on new technology, new developments, expansion. Everybody sits tight and tries to do the best they can because you'd rather keep your people than upgrade all of your technology. And therefore, the technology businesses suffer first when we go into a slowdown because everybody is looking to trim their spending. Now, this graphic has been put together by visualcapitalist.com, which is a website that I've referred to before. They do come up with some really great graphics, and I thought it was a really interesting way of showing the increase in technology layoffs over the course of the last 12 months. And the first thing to note about this chart, which is essentially a graph showing the amount of job losses in technology month by month through from January 22 to November 22, is that you can see a general trend of an increase in job losses over the course of the year, and that there's been a significant increase in numbers from May onwards. So this links directly to what's been happening in the global economy. If you follow the channel, you'll be fully aware that following Russia's invasion of Ukraine on the 24th of February, we saw a huge increase in the price of oil and gas and other commodities, and that drove up inflation all across the world. And as a result, over the course of the last 6 months or so, we've started to see central banks increasing interest rates, and that's led to a global slowdown. And the impact of that global slowdown can be clearly seen in the job losses in the technology sector. And the other thing that stands out initially from looking at this chart is the number of different companies that have announced layoffs. If this chart was dominated by one or two companies, then those job losses could be down to specific reasons related to that business. But as you can see from the chart, there have been multiple companies that have laid off large amounts of staff all through 2022. Amazon has announced that its layoffs will increase to more than 18,000 roles as part of a workforce reduction. The layoff decisions, which Amazon will communicate starting January the 18th, will largely impact the company's e-commerce and human resources organisations. The cuts amount to around 6% of Amazon's 300,000 person corporate workforce and represents a swift turn for a retailer that recently doubled its base pay ceiling to compete more aggressively for talent. The reversal of Amazon's fortunes has been stark. It changed from a business deemed essential during the pandemic for delivering goods to lockdown homes to a company that overbuilt for demand. Meta, the parent company of Facebook, WhatsApp and Instagram, has advised workers that it intends to cut the headcount by 11,000 employees, or around 13%, amid falling revenue, grim global economic forecasts and increased competition. The firm will also extend its hiring freeze through the first quarter of 2023 and cut discretionary spending in a bid to become a more efficient and streamlined company, as well as restructuring teams, reducing its real estate footprint and cutting perks. Meta said it would pay US workers 16 weeks of base pay plus 2 additional weeks for every year of service as part of its severance package, as well as cover health insurance for people and families for 6 months and pay for all remaining paid time off, with similar support for those outside the US. Chief Executive Mark Zuckerberg took responsibility for the decision and told employees he erroneously expected the surge of e-commerce and growth at the onset of the COVID-19 pandemic would be a permanent acceleration and that would continue even after the pandemic ended. I got this wrong and I take responsibility for that. Not only has online commerce returned to prior trends, but the macroeconomic downturn increased competition, and ad signal loss have caused our revenue to be much lower than I'd expected. Now, in terms of the impact of redundancies on a business, there are multiple implications. Firstly, there is the cost. Obviously, when you release somebody, you have to sever their contract, and those contracts will contain terms and conditions as to what you need to pay them when you come to terminate that deal. Now, in most countries around the world, there are statutory amounts that need to be paid, and quite often this will relate to the length of service that somebody has completed. So if you've worked for a company for 10 years, you may receive 1 week's pay for every year that you've been there. That sort of deal is quite common. But in many circumstances, in the initial round of redundancies, companies may offer a better package. They may offer something more attractive in order to encourage people to accept the deals. This is particularly a situation when you've got voluntary redundancy. If you're looking for people to put their hand up and say, yes, I'm quite keen to leave, then generally you want to make that deal better than a deal that they may get just as a standard offer. And often in situations when you have multiple redundancies, the offer on the table can actually be worse the later you leave. So people are usually quite keen to be the first out if they don't enjoy working at that company. So making people redundant actually has a negative impact on the cash flow of your business in the short term, because you're having to pay these people a lump sum to actually exit the business. So over the long term, making people redundant reduces your costs and therefore gives you a chance to potentially make more profit. However, in the short term, there's a cash flow implication because you're having to pay people weeks and weeks worth of money up front to get rid of them. But in addition to the cash cost of getting rid of people, there are a number of other factors that companies have to bear in mind. Firstly, they will have less personnel. That's the whole point of getting rid of people. And that can cause problems if you don't have the right people in the right roles. So that can cause a contraction in your sales if you're not able to handle the level of volumes that you're looking to deal with. Another factor to bear in mind for redundancies is morale. If you're working for a company that suddenly starts to cut its workforce, that causes concern amongst the staff. They then become worried that their job might be at risk. And what tends to happen in those situations is that the more mobile people, the people who are actually more valuable to your organization, start to think about leaving. And they actually might decide to jump ship. They could actually resign, move to some other company that isn't making any redundancies. So the net impact can actually be a situation where you cut some staff and then some of your better people resign, leave to go somewhere else. And you can find yourself in a situation where you're then left with the staff either who don't want to leave or are unable to find another job. And from a reputational point of view, cutting staff can also have a negative impact, because if your company is seen to be a company that's at risk, then your competitors can take advantage of that. They'll be using that as leverage against you when they're pitching for new business. Or your clients may decide that they want to switch their accounts to another company that doesn't have any financial concerns. So whilst on paper cutting staff reduces your costs and therefore should enable you to make more profit, actually the longer term implications can be quite negative for your business. And it can also indicate future problems with regards to your organization and future profitability. So what's the summary and conclusion today? Well, I wanted to post this video because we all know that the global slowdown is happening right now. And the big question is, will we go into recession during 2022? Some countries such as the UK and Russia are already in recession, but there's a big question mark over a number of other countries around the world. And the US, I think, is one of the big questions. Will the US go into recession during 2023? And the technology companies are a fantastic bellwether. They give us an early warning indicator as to whether or not there are specific problems in specific countries. And what we've seen over the course of the last few months is that technology companies have been raising those red flags. They've been saying, yes, we've got problems. We're going to have to cut our costs because things are not going to plan. But the bigger indicator here is that we're seeing a global slowdown in promotion and marketing and advertising spend. And that always gives us the heads up that there's trouble ahead, because that expenditure is the first that you cut from your budget when you're looking to trim your costs. Rather than cutting people, you can cut back on your marketing and promotion expenditure. But the problem with doing that is that the whole point of that expenditure is to drive future sales. So if you cut back on it, therefore your future sales are likely to be cut back also, and that is likely to lead to a slowdown of your business, a reduction in profitability, and therefore at some point you may need to make headcount cuts. And that's really the situation that we're in right now. A lot of businesses are doing their best to reduce their expenditure to the absolute minimum. But there will come a tipping point when you can't cut those costs any further. And if your revenues are dropping or you're not growing at the same rate as you were expected to, then you may then need to start cutting your staff. And technology companies are already there. It's estimated that around 150,000 job losses were experienced in the sector in 2022. And it's likely that other industries are going to follow suit over the course of the next 3 to 6 months. And if we take a step back and look at what's happening in the wider economy, we've still got really high rates of inflation all across the world. It's coming down slightly in some countries, so we've got inflation of around 7% in a lot of economies, but that is significantly above the 2% target rate that everybody's going for. So the knock-on impact of the high inflation is that interest rates have been racked up over the course of the last 6 months, and those increases in interest rates have raised the price of debt. So therefore, people are not taking on new debt, they're trying to avoid it. People with existing debt know that when their fixed deals come to an end, they're going to have to refinance on a potentially much more expensive basis. So there's a lot of nervousness around right now. And as a direct result of that nervousness, people are spending less. GDP is contracting in a lot of countries. In addition to all of those issues, we've got major problems occurring in China right now, which is the second largest economy in the world. We've had problems with regards to the housing sector. We've seen a real slowdown because housing is intrinsically important to the Chinese economy. And now we've got the release of the COVID restrictions. And what that's resulted in is a mass outbreak of COVID all across the country. That's reducing workforce numbers, and therefore productivity is reducing. And it's likely that China will see a further slowdown over the course of the next 3 to 6 months. So all of these factors strongly indicate that the global slowdown is continuing and that it's actually picking up pace as we go through the first quarter of 2023. And it's likely that we'll see over the course of the next month or so more job redundancies being announced by big companies, and these are the ones that are hitting the headlines. And behind those headlines, there are hundreds and thousands of smaller companies that are making smaller workforce reductions. But when you add up the cumulative impact of all of these job cuts, it's bad news for the global economy. So the news that we're seeing from the job market gives us a very strong indicator that it's likely that a lot of countries are going to go into recession over the course of the next 3 to 6 months. Now, hopefully at the back end of 2023, we will see a recovery, we will see a return to growth if things stay as they are. But as I've mentioned before, the war in Ukraine is still going on. We've still got the uncertainty that that situation is causing for the global economy. And until we get resolution on that conflict, it's likely that we'll see more market shocks, and it puts a big question mark over whether or not that second half recovery will come during 2023. So hopefully you enjoyed today's video, you found it useful, informative, and thought-provoking. If you've liked what I've said, then please give me a thumbs up, and thank you for watching this video all the way through to the end.